Well, reason for the call today, John, is something just came across my desk, John. It is perhaps the best thing I've seen in the last 6 months. If you have 60 seconds, I'd like to share the idea with you. You got a minute? Name of the company, Aerotine International. It is a cutting-edge, high-tech firm out of the Midwest.
Do you remember this scene? Jordan Belfort, played by Leo DiCaprio in The Wolf of Wall Street, is selling penny stocks like it's free money.
But I never ask my clients to judge me on my winners. I ask them to judge me on my losers because I have so few.
But is that real? Can you actually make money with penny stock, or is it all just a giant scam? Well, today we're diving in. We're breaking it down into what penny stocks are, the different types, how some actually turn into billion-dollar investments, and whether you can realistically profit from them. Let's get to it. All right, let's start with the basics. Penny stocks are stocks that trade for less than $5 per share. They usually belong to smaller companies with low market caps and trade on smaller exchanges or over-the-counter, or OTC. These stocks are highly volatile, can move fast, and are often hyped up on social media. Fun fact, Ford, AMD, and General Motors were once considered penny stocks. But before you get hyped, for every success story, there are hundreds of companies that crashed and failed. Now, not all penny stocks are the same. Let me break it down into the three main categories. The first are NASDAQ and NYSE penny stocks. These are penny stocks that trade on major exchanges like the NASDAQ or the New York Stock Exchange, but are still under $5. Think about Ford back in 2008 during the financial crisis, or SiriusXM before it blew up. Next, you have over-the-counter or OTC stocks. These stocks don't trade on major exchanges and are often riskier because they have less regulation. And finally, you have the pink sheets and the gray market stocks. These are the Wild West of penny stocks.
Where are your Quotrons?
Quotrons?
Yeah, computers.
No, we don't even need computers here. We just trade right off the pink sheets here.
Pink sheets?
Yeah, they're penny stocks. Companies that can't get listed on NASDAQ, they don't have enough capital, their shares trade here.
These are the companies that barely have any financials, aren't required to file with the SEC, and are playgrounds for scammers. Now, let's watch a piece of The Wolf of Wall Street.
Jesus Christ, the spread on these is huge.
Yeah, and that's the point. What's your name again?
Mine, Jordan Belfort.
Jordan, what do you get on a blue chip stock?
I make 1%. I did make 1%.
Pink sheets, it's 50.
In this scene, it tells you exactly why penny stocks are so volatile and why salesmen love selling them so much. Unlike large cap stocks like Apple or Microsoft, penny stocks have very wide bid-ask spreads. This means that the price that buyers are willing to pay, the bid, and the price that sellers are asking for, the ask, can be very far apart, sometimes even several cents per share. Now for Amazon, which is trading at around $200 right now, a 2-cent bid-ask spread is basically nothing. But when there's a stock trading at 10 cents, like a penny stock, a 2-cent difference can be a 20% swing. And here's the kicker. Penny stocks trade in 1-cent increments, not fractions of a penny like larger stocks. This means that price movements are much more dramatic compared to blue chip stocks. A stock going from 5 cents to 10 cents is a 100% gain. But it can just as easily drop back to 3 cents, wiping out half of your money in seconds. For salesmen, that was gold. The hype was easy to sell, the stock could double in seconds, which sounds amazing, but until you realize that it can also crash as fast. That's why pump and dump schemes work so well. So for example, salesmen like Belfort didn't care if the stock was good or bad. They just needed high commissions, and penny stocks gave them exactly that. That's why they pushed these garbage stocks so hard. The stock price didn't matter, only the amount of buyers that actually were going into these stocks. By the time retail traders caught on, it was already too late. But what about the companies that actually made it? Well, the reality is that the biggest example of a penny stock that made it big is Monster Energy. Once an OTC penny stock trading under $1, Monster used to be a small energy drink company. And now it's a multi-billion-dollar brand competing with Red Bull and trading over $53 per share. So yes, some penny stocks do break out and make it big. But here's the thing. For every Monster beverage, there are thousands of companies that crash and burn and completely wiped out. And that's why it's so risky. I already covered the volatility, which is driven by the bid-ask spreads, and also the manipulation of pump and dumps, where people try to hype up the price and then get out before the stock goes down. And an additional issue is liquidity, which is that even if the stock goes very high up, there's also a risk that you're not gonna find enough buyers to take the shares from you by the time that the stock is already high. And if you can't get out, you're stuck with the shares until someone else wants to come in and take the trash from you. So, can you actually make money with penny stocks? Yes, but the odds are against you. And the odds of you beating the S&P 500 from investing in penny stocks is even lower. If you do want to trade penny stocks, I will treat it like gambling. Only risk what you can actually afford to lose. I hope this video helps, and I'll see you next time. Peace!